Welcome back to the deep dive. It is Wednesday, January 21, 2026. And honestly, if you were to try and pitch a movie script to Hollywood based on the state of the world this morning, they would reject it.
Oh, they'd laugh you out of the room.
Yeah, they'd tell you it's too heavy-handed, way too unrealistic, and that the plot points just don't, connect.
It is absolute chaos out there. I mean,
Oh.
we're looking at a news cycle that is equal parts terrifying, confusing, and arguably economically historic.
Right.
It feels like the writers of this reality just decided to throw every possible plot twist at the wall to see what sticks.
Historic is definitely one word for it. Dumpster fire might be another, but that feels a little too 2024. Let's look at the board right now.
Yeah.
We have a trade war that has literally started because of a real estate bid for an island.
Right.
We have the streaming wars ending in a $72 billion explosion, with Netflix effectively becoming the new cable bundle. And then, just to keep things interesting, the zombie of Silicon Valley Intel has risen from the dead with a rally that just defies gravity.
It is a lot to process. And the markets are reacting exactly how you'd expect them to react when uncertainty is the only certainty left. The S&P 500 is down, the NASDAQ is taking a beating, but there is one number on the board that tells you everything you need to know about the psychology of the world right now.
You're talking about gold.
Gold, hitting a record high of $4,777 an ounce.
That is staggering. 4,777, nearly $5,000 for an ounce of gold. I remember when people thought 2,000 was the absolute ceiling.
It's the ultimate flight to safety. It is the universal financial signal for, I don't know what is happening, but I don't trust paper money right now. I mean, when you have the President of the United States threatening to tariff European allies because they won't sell in Greenland, investors run for cover.
So that is our mission today on this deep dive from Theta Fuse. We are not just going to review the headlines. We are going to connect these dots. We need to understand how geopolitical ego is driving market volatility, why corporate consolidation is changing how you spend your Friday night, and maybe why legacy tech might actually be the safest bet in your portfolio.
Let's dive in.
We have to start with the main event, the Greenland Tariff Shock. Okay, let's unpack this because it sounds like a joke. It sounds like something from a satirical news site. But the economic fallout hitting us is very, very real.
It is very real. And to understand the shock and why gold is sitting at nearly $5,000, you have to look at the timeline. This has been brewing, but it escalated rapidly this week. The base layer is simple. President Trump wants to buy Greenland. Again.
Yeah, right. Which is a semi-autonomous territory of Denmark. It's not just a piece of real estate you can find on Zillow.
Exactly. And Denmark, naturally, said no. They have said no before, quite politely. But this time, the rejection triggered a scorched earth response. The White House released a statement explicitly citing national and world security as the justification for demanding the purchase. Trump posted that there can be no going back and that, quote, everyone agrees on this.
National and world security. That is a heavy phrase to throw around for what is essentially a land acquisition. But here's where it gets really interesting and, frankly, dangerous for the global economy. It's not just a diplomatic spat anymore. It's a trade war.
It is. Because Denmark said no, the administration has announced a blanket 10% tariff on 8 European countries. And that kicks in fast February 1st.
That is less than 2 weeks from now.
Less than 2 weeks. And it gets worse. If there's no agreement to sell Greenland by June 1st, those tariffs jump to 25%.
25%.
And this applies to any and all goods sent to the U.S. from these nations. So we are talking about Germany, France, the UK, the Netherlands. These are major trading partners. This isn't just about Danish butter cookies. This is German cars, Dutch medical equipment, French aerospace parts.
And the reasoning behind this, you dug into the source material regarding the correspondence with Norway. This is the part that just feels so surreal. It's the psychological key to this whole thing.
It is bizarre. We have access to details about a letter Trump sent to the Norwegian Prime Minister, Jonas Gahr Støre. In this letter, Trump explicitly linked his desire to purchase Greenland to being snubbed for the Nobel Peace Prize.
Wait, hold on. Let's just slow down and unpack that. He wants to buy an island because he didn't get a medal.
That's the logic. According to the letter, his logic is that he felt he deserved the prize. And since the global establishment denied him that recognition, he is now prioritizing what is good and proper for the United States, which in his view equals complete and total control of Greenland.
So it's a transaction.
It's basically a transaction. You denied me the prestige I wanted, so I am taking the strategic asset I want. It's just laid bare.
And the kicker. The punchline.
The kicker is that the Norwegian prime minister had to issue this very awkward public statement reminding the U.S. president that the Norwegian government doesn't even award the Nobel Peace Prize.
Oh, that's right.
It's an independent committee. The government has absolutely no say in it. But that didn't stop Trump from attacking Norway anyway and claiming he doesn't care about the prize.
It's geopolitics governed by personal grievances. And speaking of grievances, we have to talk about the wine war. Because it's not just the Nordic countries getting hit. France is in the crosshairs, too.
This is a classic example of how modern diplomacy is being conducted. We aren't waiting for ambassadors to meet in stuffy rooms anymore. French President Emmanuel Macron reportedly texted Trump.
A text message.
A text message.
Oh, roughly.
Macron wrote that he was, quote, confused by the Greenland pursuit, which, to be fair, a lot of people are.
I think confused is the word of the day, yeah.
But crucially, in that same text, he declined an invitation to join something called the Board of Peace for Gaza.
The Board of Peace. I keep seeing this in the sidebars of the news. Who is actually on this board?
Well, it was supposed to be a coalition for rebuilding Gaza, but it's morphed into this strange group. We're talking about Vladimir Putin, Argentina's Javier Milei, and Mark Carney.
Mark Carney, the former central banker from the Bank of England and Canada.
The very same. So you have an autocrat, a libertarian chainsaw wielder, and a technocrat banker. It's a very random assortment.
It's like the beginning of a bad joke.
It is. And Trump wanted Macron to join to give it legitimacy. Macron said no.
And the response to that no wasn't a diplomatic cable expressing regret, I'm guessing.
No. Trump told reporters, and this is a direct quote, I'll put a 200% tariff on his wines and champagnes and he'll join.
200%.
200%.
Let's just do the math on that for you listening. If you buy a bottle of, say, Veuve Clicquot for $60 with a 200% tariff, that bottle is now $180. That effectively kills the French wine export market to the U.S. overnight.
It does. It destroys it. And you saw stocks react immediately. LVMH, which owns Veuve Clicquot and Krug and a dozen others, dropped 2% instantly. This isn't theoretical. Billions of dollars in market cap are evaporating because of a text message.
So Europe is obviously not taking this lying down. The rhetoric coming out of Brussels is noticeably different this time. In the past, whenever tariffs came up, the EU tried to de-escalate. They talked about shared values and partnership. What are they saying now?
Ursula von der Leyen, the EU Commission president, gave a speech that I think historians will look back on as a turning point. She said, we are at a crossroads and that the world order has shifted permanently. She said, quote, we now live in a world defined by raw power.
That is a chilling line, defined by raw power.
It implies the rules-based international order. The WTO, the treaties, the handshakes, it's gone. It's over. And if the game is now raw power, Europe is looking for a weapon.
And they can't win a trade war dollar for dollar.
No, because the U.S. market is so consumer-driven. But Deutsche Bank pointed out exactly what weapon Europe does have.
The nuclear option.
The financial nuclear option. Europe holds roughly $8 trillion in U.S. assets. A significant chunk of that is U.S. Treasury's government debt. George Saravelos, who's the head of currency research at Deutsche Bank, warned that if the U.S. weaponizes trade, Europe could weaponize the bond market. They could start dumping U.S. treasuries.
Okay, let's break that down for the listener who might not live in the bond market. If Europe starts dumping treasuries, selling them off in massive quantities, what happens?
Well, it's basic supply and demand. If you flood the market with sellers, the price of the bonds crashes. When bond prices crash, the yield, or the interest rate the U.S. government have to pay to borrow money, spikes.
And that yield is the benchmark for everything in our economy.
Everything. Your mortgage rate, your credit card rates, business loans. If yields spike because Europe is dumping our debt, the U.S. economy grinds to a halt, the dollar would crash. It's economic suicide for everyone involved. It's mutually assured destruction. But it's a threat that says, if you burn our economy with tariffs, we will burn your credit rating.
And yet we have Scott Bessent, the U.S. Treasury Secretary, sitting in Davos right now. How is he handling this threat? Is he panicking?
Quite the opposite. His strategy seems to be total dismissal. When asked about Denmark already selling some treasuries, which they have started doing, by the way, Bessent called it irrelevant.
Irrelevant, yeah.
He said it's less than $100 million so far, and he's not concerned at all.
That is a bold stance when you are staring down a trade war with your biggest allies.
It is reckless confidence. He's betting that Europe won't actually pull the trigger on the nuclear option.
Yeah.
But in a world defined by raw power, betting on rationality is, it's a pretty risky bet.
Let's bring this back to the listener, because when we hear tariffs, it's easy to think of it as a tax on companies. Oh, French companies have to pay more. But there is a new study out from the Kiel Institute that just blows that idea out of the water.
This is the aha moment for anyone watching their wallet. The Kiel Institute for the World Economy ran the numbers on who actually pays for tariffs. There's this political narrative that the foreign country pays,
Yeah.
but the data says otherwise. They found that foreign exporters do not lower their prices to absorb the tax.
So if the price of a French wine or a Danish medical device goes up 10% because of the tariff, the company doesn't eat that cost.
Nope. The study shows a near-complete pass-through of 96%,
96%.
which means 96 cents of every dollar collected in tariffs comes directly out of the American buyer's pocket.
It is a consumption tax, plain and simple.
Exactly. It's not a tax on France or Denmark. It's a tax on you. The U.S. government is essentially raising taxes on its own citizens and calling it a trade strategy. And that is why we are seeing inflation concerns ticking back up, even though central bankers like Christine Lagarde are trying to downplay it.
Yeah.
You can't just slap a 10% tax on everything coming from Europe and not expect your grocery bill to go up.
And meanwhile, Trump is in Davos today, meeting with various parties. You can only imagine the tension in those conference rooms.
Oh, it's palpable. You have the global elite trying to discuss climate change and AI, and the American president is there trying to buy an island and threatening to tax everyone if they don't agree. It creates an environment of extreme volatility. Hence, gold at $4,777. Investors don't know what rules apply anymore, so they buy the shiny metal that has survived every empire collapse in history.
Okay, let's pivot. Because while the geopolitical map is being redrawn with a Sharpie, the media landscape is also getting a massive overhaul. This news dropped like a bomb. Netflix is buying Warner Bros. Discovery.
A $72 billion bomb.
$72 billion. This is the deal of the decade for media. And I find this fascinating because Netflix was the disruptor, right? They were the ones who killed Blockbuster. They killed the cable bundle. And now they are buying the most legacy of legacy studios.
The irony is rich, isn't it? For years, the narrative was cord-cutting. We were unbundling. You could pick and choose services. But look at what this deal actually does. Netflix acquires HBO, CNN, the Warner Bros. Movie studio, the entire DC Comics universe.
They are basically recreating the cable bundle just inside an app.
Precisely. They're rebuilding the thing they spent a decade destroying. It's the great rebundling.
But why? Netflix was the king of growth. Why buy a dinosaur like Warner Bros. Discovery? Is it just for the library?
Well, Ted Sarandos, the co-CEO of Netflix, is spinning this as a pro-consumer and pro-growth move. He says it's a vertical deal. They get access to 100 years of intellectual property,
Right.
Harry Potter, Batman, Game of Thrones, Looney Tunes, all of it.
Which is valuable, sure. Content is king. No argument there.
But Sarandos also said something interesting about talent. He admitted they need the Warner Bros. Teams because they run businesses Netflix doesn't understand. Netflix is a tech company. They don't really know how to run a theatrical movie release schedule or a 24-hour news network like CNN. They need that institutional muscle.
But if you look at the analyst reaction, Wall Street isn't throwing a parade. Netflix stock was down slightly on the news. Why the skepticism?
It's the numbers behind the curtain. If you look closely at Netflix's recent performance, the growth engine is sputtering. They missed their viewing hour estimates. Viewing was only up 2% in the second half of 2025.
2%. Compare that to the double-digit growth we were seeing just a few years ago.
Exactly. The full year prior was 9%. Now it's 2%. Growth is stalling out.
And subscriber counts.
325 million total, which is huge, but it trailed estimates. And this brings us to the real threat. The reason Netflix spent $72 billion isn't to fight Disney Plus, Can't Just TV and Go. It's not to fight Amazon Prime.
It's the phone in your pocket.
It's TikTok. It's Instagram Reels. Guggenheim analyst Jeff Lodarczak put it perfectly. He said the problem is short-form entertainment, destroying attention spans.
That is a fascinating take. So Netflix isn't buying Warner Bros. To fight for the movie night slot. They are fighting for the dopamine hit slot.
It's a defensive move against a fundamental change in human behavior. Lodarczak argues that short-form video is doing to streaming what streaming did to cable. Younger consumers have, 15-second attention spans.
Right.
Netflix is betting $72 billion that if they own all the best long-form content, everything from Friends to House of the Dragon, they can force people to keep watching something longer than a minute.
It's a survival story. They're trying to build a moat so deep and so full of content that you never even think about leaving the app.
It is. And financially, this is going to be messy. They have already earmarked $275 million just for integration planning.
Integration planning is just corporate speak for firing a lot of middle managers and trying to get different email systems to talk to each other.
And destroying operating margins in the short term. Merging these two cultures, the Silicon Valley data-driven culture of Netflix and the Hollywood creative-driven culture of Warner Bros., is going to be a nightmare. We've seen this before with AOL Time Warner. It's hard to mix oil and water.
But it signals something important for you, the listener, if you're holding tech stocks. Netflix is no longer a high-growth tech stock. It is a utility. It is becoming the water and power company of entertainment.
Right.
You have to have it, but it's not going to double in size every year anymore.
Exactly. It's a blue-chip utility now. Safe, maybe. Boring, probably.
Yeah.
But in a volatile market like this one, boring can be good.
All right, speaking of nightmares turning into dreams, let's talk about the biggest comeback kid in the tech sector, Intel.
The zombie of Silicon Valley.
Seriously, if you told me 2 years ago that we would be doing a segment on Intel being the hottest stock in 2026, I would have laughed you out of studio. I mean, this company was left for dead. They missed mobile. They missed AI.
It is unbelievable. The stock soared 84% in 2025, and it is up another 31% just in the first few weeks of 2026.
That is crypto-level growth for a legacy chip maker. And meanwhile, NVIDIA, the king of AI, the golden child, is actually down about 4% recently. What is happening?
The tables have turned, and it all comes down to one man, Lip-Bu-Tan.
Let's talk about him, because Pat Gelsinger was the CEO before, and he was the visionary, right? He had these huge dreams of regaining dominance. But he was ousted in late 2024. Lip-Bu-Tan took over in March 2025. What did he do differently?
He stopped the bleeding. Gelsinger was a visionary, sure, but he was spending money like it was water. He had this, if we build it, they will come, attitude toward building new factories or fabs. Lip-Bu-Tan came in with a machete. His philosophy was simple: no more blank checks. Extreme discipline. He cut costs. He laid people off, which is painful but was necessary to save the ship. And he was brutally honest with investors. He basically said, we are not building anything unless we have a customer signed on the dotted line. He stopped trying to be everything to everyone.
And that discipline attracted cash. A lot of cash.
The deal sheet for Intel in 2025 is insane. First, they unlocked an $8.9 billion equity investment from the U.S. government.
Okay, that makes sense. The CHIP PS Act money finally flowing. The U.S. government cannot afford to let Intel fail. It's a national security issue. They need chips made in America.
Right. Then SoftBank came in with $2 billion. But the one that made my jaw drop, the one that really shocked the Valley, was the $5 billion investment from NVIDIA.
This is the part I love. NVIDIA, their biggest competitor, basically the company that made Intel look obsolete in the AI race, gave them $5 billion. Why? Why would Jensen Huang write a check to his biggest rival?
It's the frenemy dynamic. You have to understand the supply chain. NVIDIA designs the world's best AI chips, but they don't build them. They are fabulous.
Right.
They need a foundry, a factory, to physically manufacture the silicon. For years, that was almost exclusively TSMC in Taiwan.
But with geopolitical tensions rising in Asia, that's a huge risk.
Exactly. NVIDIA looked at the map, saw the tension around Taiwan, and realized they had a single point of failure. If anything happens to TSMC, NVIDIA has no product. They needed a backup plan. They needed a U.S. manufacturer. And Intel's the only game in town.
So now Intel is making custom CPUs for NVIDIA.
It's a partnership.
Hey.
Intel swallowed its pride. They admitted they lost the GPU war. They said, fine, we won't beat you at design, but we will build your chips for you. And that pivot saved the company.
It's a brilliant strategic move. You don't have to be the gold miner. You can just sell the shovels to the guy finding all the gold. And in this case, Intel is the shovel shop.
And there's a rumor that could be the cherry on top of this whole story.
The Apple rumor.
Yes. The word on the street, and it's getting louder, is that Apple is considering using Intel's 18A process for its M-series processors in 2027.
For the non-techies listening, let's just explain 18A. This is the manufacturing process node, right? The size of the components.
Right. 18A refers to 1.8 angstroms. It's the size of the transistors. Smaller is better. It means more power, less heat. Intel's 18A node is supposed to be faster, more efficient, and denser than anything TSMC has right now. It's their big bet.
And Apple is notoriously picky. They left Intel years ago because Intel's chips were getting too hot and too slow if Apple comes back.
If Apple agrees to let Intel make their chips, that is the ultimate stamp of approval. It tells the world that Intel's manufacturing is back to being world-class. It would validate the entire turnaround strategy. it would be a game changer.
So Intel went from a value trap, a stock that looks cheap but just keeps going down, to a momentum play. They admitted defeat in some areas, they partnered with their rivals, they just focused on execution.
It's a lesson in humility, really. Liputan didn't try to be the hero. He tried to be a good businessman. And the market rewarded him with an 84% rally.
So let's zoom out. We have trade wars destroying the old order, we have media monopolies consolidating the new order, and we have tech resurrections. I want to look at the macro picture, specifically energy, because usually when the world is this chaotic, oil is going nuts.
Oh, yeah.
If there's a crisis, oil goes up. That's the rule.
But it's not. That's the anomaly here. Brent crude is steadying near $65 a barrel.
That is incredibly low, considering everything. You expect a huge risk premium with all this geopolitical tension.
You would. But the International Energy Agency, the IEA, sees a massive supply surplus. There's just too much oil floating around. We have a glut.
And demand it's decent.
Demand is okay, but supply is just outpacing it. And interestingly, geopolitical friction is actually adding more oil to the market, not less. Look at Venezuela.
Right. The U.S. is allowing more traders to buy Venezuelan crude now.
It used to be just a Vitol and Trafigura, the big trading houses, that were allowed to touch it. Now, the U.S. government is opening the gates for more trading companies. They are flooding the market with Venezuelan oil, probably to try and keep prices down ahead of an election.
This is where the synthesis comes in. Because usually cheap oil is a tax cut for consumers. Gas is cheap, heating is cheap. That should be great for the economy. It puts money in people's pockets.
It should be. But the Greenland Tariff Shock acts as a massive tax that negates that benefit.
Yeah.
So you're saving, what, maybe $10 at the gas pump?
Yeah.
But you're losing it at the grocery store, the electronics store, and the clothing store because of the tariffs.
It's a wash. Or worse, a net loss for the average person.
And look at the contradiction in U.S. policy.
Yeah.
On one hand, you have this aggressive America First trade stance by Greenland, or we tax you. On the other hand, you have the government pouring billions into Intel to reshore tech manufacturing.
It's a chaotic, high-stakes game. The U.S. is trying to become an island, manufacturing its own chips, controlling its own energy, expanding its territory to the Arctic.
While simultaneously alienating the allies, it needs to maintain global stability. It's a high-wire act. We are pushing our friends away while trying to rebuild our internal capacity. And if we push them too far before we are ready to stand alone, well, that's where the danger lies.
So what does this all mean for you, for the learner listening right now?
It means we are in a period where the old playbooks just don't work anymore.
Markets hate uncertainty. And right now, between a president trying to buy an island nation based on a Nobel Prize snub and a streaming giant buying a legacy studio to fight TikTok, uncertainty is the only thing we have.
It's a world where gold is nearly $5,000 because people are scared. But look at Intel. It's rallying because they finally got their act together. Chaos creates opportunity.
So if you are looking at your portfolio today, seeing all the red on the screen, just remember the Intel story. Even the biggest losers can turn it around with the right leadership and a bit of humility.
And maybe keep an eye on that Apple rumor. If that happens, the chip landscape changes yet again.
Before we go, here is a provocative thought to leave you with. We talked about the Board of Peace, Putin, Trump, Maya. And we talked about Netflix owning basically all of Hollywood history.
Right.
Are we moving toward a world of monopolies in every single sector? A monopoly on diplomatic power held by a few strongmen, and a monopoly on culture held by one or two mega corporations?
It's a valid question. If diversity of competition disappears, whether it's in the UN or on your TV screen, innovation usually dies with it. And that is a world none of us should want to live in.
Something to mull over while you watch the news tonight or while you scroll TikTok for 15 seconds. Check your portfolios, stay safe out there, and don't panic sell just yet.
Stay curious.
We'll see you on the next Deep Dive.